Welcome to the Inheritor's Tax Trap, where we demystify the step-up in basis for inherited securities and show you why your stock basis calculation might be dangerously flawed. To begin, we will frame the big idea. When someone passes away, the cost basis of their publicly traded securities typically resets to the fair market value on the date of death. However, the way you confirm that number is not as simple as checking a website. Next, we will surface the core warning. Relying on free financial portals or even corporate investor relations pages can lead to incorrect numbers that do not match what the IRS expects. Finally, we will preview the solution. Use the estate's official valuation and request a formal date of death valuation from the brokerage custodian to stay aligned with IRS standards and avoid audit risk. First, we will define step-up in basis and why it matters. Then, we will break down how fair market value is computed on the date of death. After that, we will examine why different websites often disagree by several dollars on the same ticker for the same date. Next, we will clarify why the estate's valuation and Form 706 control for tax purposes. Then, we will walk through exactly how to request a date of death valuation from the brokerage and what it includes. Afterward, we will give you a short checklist to keep your records audit-proof. Finally, we will test your understanding with quick quizzes before we summarize the key takeaways. To begin, step-up in basis is the tax rule that resets the cost basis of inherited assets to their fair market value on the date of death. This reset can eliminate substantial unrealized gains that built up during the decedent's lifetime. Consequently, the beneficiary's future capital gains are measured from the stepped-up value, not the decedent's original purchase price. This is why getting the correct number is crucial. Transitioning from this concept, let us now see how that fair market value is actually determined for publicly traded stocks. Now let us address the math. For publicly traded securities, the fair market value on the date of death is generally calculated as the average of the day's high and the day's low. It is not the closing price, it is not a screenshot from a broker app, and it is not the exact time of death print. This average is applied per security and must reflect any corporate actions, such as splits or dividends. Proper adjustments are essential because otherwise the values in your records may not match the estate's official filings. As this feeds directly into future 1099-B reporting, accuracy here prevents downstream headaches and helps avoid audit triggers. With the method established, we can now explore why free data sources often disagree on these seemingly simple numbers. Next, let us compare official sources with internet data. On the official side, the estate valuation and, where required, Form 706 carry legal weight. Brokerages can issue a formal date of death valuation that accounts for corporate actions and follows accepted calculation standards. These documents control for IRS purposes. On the unofficial side, consumer portals and investor relations pages can show different highs and lows due to varying data feeds, time zone treatments, or unadjusted prices around corporate actions. While such sites are helpful for research, they are not authoritative for tax basis. Therefore, when discrepancies arise, official filings and custodian valuations take precedence. Moving on, let us discuss why public sources disagree. Websites aggregate different data feeds, apply different adjustment policies for splits and dividends, and sometimes reflect prices that include or exclude certain trading sessions. Latency in updates or historical data backfills can also create differences across platforms for the same date. Even a small discrepancy of cents per share can compound into a meaningful tax difference if you hold a large position. Given these inconsistencies, it is risky to self-calculate your basis using internet numbers. Instead, we will now outline a practical action plan to secure an official, defensible valuation. To put this into practice, first identify the custodian where the assets are held. Second, request a formal date of death valuation for each security. Third, confirm that corporate actions such as splits, dividends, or spin-offs are fully reflected in the valuation. Fourth, obtain copies of the estate filings, including Form 706 if it is required. Fifth, reconcile the basis shown in your accounts with the custodian's date of death report to ensure alignment. Sixth, archive all documents, including the custodian valuation and relevant estate filings, so they are available for future tax reporting and any potential IRS inquiries. With the plan in hand, let us visualize the process across time. This timeline illustrates the end-to-end path from the date of death to the beneficiary's basis and eventual sale. First, the date of death occurs, and holdings at the custodian are identified. Next, a formal date of death valuation is requested from the brokerage. Then, the valuation is received and reviewed, including confirmation that corporate actions are properly adjusted. After that, the estate valuation is prepared, and Form 706 is filed if required. Subsequently, the custodian records the stepped-up basis on the beneficiary's accounts. Finally, when shares are sold, the resulting 1099-B reflects the stepped-up basis, which supports accurate capital gain or loss reporting. With the timeline in view, let us quantify where discrepancies come from. Here we list common causes of inconsistent highs and lows. Different data vendors may compute or source prices differently, creating variations in reported highs and lows. Latency can cause sites to update historical data after the fact. Unadjusted prices, particularly around stock splits, can make historical highs and lows look artificially high or low. Special dividends or spin-offs can also require adjustments that some portals may not apply. Coverage of extended trading sessions varies, producing different daily ranges. Finally, time zone handling can shift which calendar day a price is attributed to. Recognizing these sources of error reinforces why official valuations should be used. To reduce audit exposure, retain the brokerage date of death valuation in your records. Keep the estate's valuation and Form 706 if one was filed. Save custodian confirmations that show the stepped-up basis on each position. Document any corporate action adjustments that you or the custodian verified. Finally, when you receive a 1099-B after selling the shares, confirm that the reported basis matches your official records. Next, we will test your understanding with a brief quiz. Question: which source controls your inherited stock's cost basis for IRS purposes? Options: A. The estate's Form 706 value with alignment to the custodian's date of death valuation. B. The average shown on a consumer stock website. C. Your broker statement showing the decedent's original purchase price. D. Your own spreadsheet calculation. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the estate's Form 706 value, aligned with the custodian's date of death valuation. If Form 706 is required, it is legally controlling for IRS purposes. Even when Form 706 is not required, the brokerage's formal date of death valuation remains the defensible basis source. Public website numbers and personal calculations do not control for tax reporting. With that settled, let us go deeper into special cases. In practice, not every estate files Form 706. Nevertheless, you should obtain a formal date of death valuation from the custodian for defensible records. In certain circumstances, the executor may elect an alternate valuation date. And if that election is made, the basis follows the elected valuation. Multi-lot positions, partial sales, and dividend reinvestment plans require lot-level accuracy to prevent errors. When assets move between custodians, confirm that the stepped-up basis transfers correctly, because basis can be lost or misreported during transfers. With these nuances in mind, let us verify the FMV rule with another quick question. Question: how is the date of death fair market value for a publicly traded stock typically determined? Options: A. The market's closing price on the date of death. B. The average of the day's high and low on the date of death. C. The price at the exact time of death. D. A 5-day average centered on the date of death. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the average of the day's high and low on the date of death. It is not the closing price, not the price at the exact time of death, and not a multi-day average. This rule, combined with proper corporate action adjustments, forms the authoritative basis. Next, we will give you a ready-to-use template to request a formal valuation from your custodian. Here is a concise template you can email to your custodian to request a date of death valuation. The template identifies your role, the decedent, the account, and the date of death. It requests a formal valuation using the average of the day's high and low, adjusted for all corporate actions, and asks for alignment with estate reporting standards such as Form 706 when applicable. It also requests lot-level detail and a confirmation of processing time and fees. With your request ready, let us consolidate the takeaways. These are the most important points. The estate's valuation and Form 706, where required, control for IRS purposes. You should request a formal date of death valuation from the custodian. Fair market value on the date of death is computed as the average of the day's high and low. Public website data is not authoritative for tax basis, especially when discrepancies appear. Preserve all documents to ensure your future 1099-B filings align with the official basis. In summary, step up in basis can eliminate years of unrealized gains, but only if you use the correct fair market value. Differences across public websites are common and can materially impact your reported basis. Official documentation, including the estate's valuation and Form 706 when applicable, overrides internet data. Therefore, request the brokerage date of death valuation and keep thorough records. Ultimately, precision prevents audits. Before we close, let us include a brief disclaimer. This content is for educational purposes only and does not constitute tax, legal, or investment advice. Tax laws and filing requirements vary and can change. You should consult a qualified tax professional or estate attorney who can evaluate your specific facts and documents, including whether a Form 706 filing is required and how any elections may affect your basis. Do not rely solely on publicly available price data to set your tax basis. Thank you for watching. If you found this helpful, please like the video, share it with anyone navigating an inheritance, and subscribe for more clear, practical guidance. In the comments, tell us your biggest challenge with inherited assets or cost basis, and what topics you want us to cover next. See you in the next one.